Jai Shankar, and a warm welcome to all the attendees of this fourth session of Avakash, which is a series of interactive knowledge and skill session with experts in various fields. Let us begin with Sabha Prarambha Prarthana. Dakshinasya Samarambha Shankaracharya Madhyama Asmadacharya Paryanta Smarya Guru Parampara Shruti Smriti Purananam Alayam Karunalayam Namami Bhagavat Padam Shankaram Loka Shankaram Shankaram Shankaracharyam Keshavam Vadarayanam Sutra Bhashya Krutau Vande भगवन्तौ पुनः पुनः ईश्वरो गुरुरात्मेति मूर्तिभेदविभागिने व्योमवद्व्याप्तदेहाय दक्षिणामूर्तये नमः परिज्ञानाश्रम श्रीगुरुशङ्कर परिज्ञानाश्रम शङ्कर सद्गुरु केशव वामन कृष्ण पाण्डुरङ्ग आनन्द परिज्ञान गुरु सद्योजात शङ्कर सद्गुरु गुरुर्ब्रह्मा गुरुर्विष्णु गुरुदेवो महेश्वरः गुरुः साक्षात् परब्रह्म ॐ सहना भवतु सहनौ भुनक्तु सह वीर्यं करवावहै तेजस्विनावधीतमस्तु मा विद्विषावहै ॐ शान्ति शान्ति शान्तिः. For today's session, let's continue with the second half of equity and mutual fund investment. My fellow Yuvas and Yuvatis who are attending for the first time, it gives me great pleasure to introduce Sandeep Bhat Bijoor. He is a practicing chartered accountant with a vast experience of 30 years in the field of finance and financial consultancy. In his eminent career, Sandeep Mam has worked as Chief Financial Officer of Aditya Birla Private Equity. He has worked in the investment banking and stockbroking field as Chief Operating Officer at UBS India and CLSA India, also as CFO at ABN AMRO India. He has also served as Head of Portfolio Management at JM Share and Stockbrokers. Sandeep Mam is proficient in technical analysis covering different verticals like global stock, debt, currency, gold, and oil markets. Based on this proficiency, every Tuesday, Sandeep Mam used to write a column for the newspaper Afternoon Dispatch and Afternoon Dispatch and Couriers on technical analysis on the indices. Please join me in welcoming Sandeep Mam for this session of Avakash. Before we begin, let me reiterate some ground rules for this webinar. Every attendee shall stay on mute mode during the presentation. Attendees may also switch off their cameras while the presentation is on. If any one of you have queries on the presentation, you are requested to type your query on the WhatsApp group or on the chat of Microsoft Teams. The moderator shall enlist or summarize the queries from the chat. These queries shall then be answered by Sandeep Mam at the end of the presentation. Over to you, Sandeep Mam.
Thank you very much, and welcome all those who have been in this session previously. This would be the last session, but it'll be an interesting one because it's completely different from what we were witnessing earlier, because this is more of a technical analysis skills, which gives you a perfect insight into what might happen in the future for the markets, let alone the stock markets, but as mentioned, it can be applied to all the other markets as well. So I'm going to jump up to the fifth portion of the agenda here, which is technical analysis, because the first four have already been uh, taken up previously. But I am sure you might have questions on the first four as well. So at the end of the discussion, you can actually ask any of the questions you may have for the first four as well. So let me go on to the item number 5 in technical analysis. Uh, this is a very, very old, method of actually uh, putting prices in from the point of view of the stock market. Originally, if people knew or have known, I don't think any of you might have known because you might have been kids. Uh, Electronic trading on the exchanges in India started in 1995 with the formation of the NSE. So prior to that, there used to be a stock exchange, a hall where trading hall, which used to be there, where brokers would go and physically, exchange notes as well as buy and sell stocks, and used to come to a decision on the price for depending on the demand or supply. Now, every market has a demand and supply, as I've told you in the past. Now, that used to happen earlier in the Mumbai, or rather the Bombay Stock Exchange building. But uh, the whole concept of trading and the mechanism of getting hold of, uh, I would say, the trading prices was started by Mr. Charles H. Dow, who built the first indices in the year 1897. Uh, it's a long, long time ago. There were definitely no computers at all. And what we used to do, in fact, as even proponents or those who are interested in technical analysis, was to have what is called the graph paper, which had it used to be green in color, and it used to have uh, squares, and all the prices used to be plotted on those graph papers. So that's how it all started. And Charles Dow, what he did was, from the 20 most important companies, the railroad companies at that time, and 12 industrial companies constituted the Dow indices, what is right now called the Dow Jones Composite of 100 companies. Uh, and the only company which is now there still in vogue in the Dow is General Electric, which is GE. Um, and some of the things which he said and mentioned even today are very, very important from the point of view of how things work out on a psychological level in the stock markets. Now, when you have stock markets and you actually have to predict stocks, what happens is the basic tenets, which is the second bullet point, is the averages or the prices of each and every stock discount everything. So insiders might be knowing very well what is going to happen to a particular stock, because they might be doing, they might be doing well. The turnover might have gone up, or the turnover might have gone down. So the prices generally, if the turnover would be good or the profits are likely to be better in the future, you will see automatically that the prices would start going up. The moment that goes up, what we say is, we know that the prices are going up for some reason, which means the insiders have started knowing that the prices are going up. What it means is the prices discount everything, or the averages, the indices also discounts everything. So what generally happens in that case is, on a particular day, suppose the results of a company is likely to be, announced tomorrow, and the prices have been going up for the last 1 month. People are aware that the prices are going up. They might not be knowing the reason, but the people in the inside of the company or those who are friends and family members might be knowing why the prices are going up. Um, on that particular day, when the results are declared, technical analysis is such a game where when the prices are moving up, you know the trend of that market or the stock. So you can enter a stock based on the price movements of that stock. And on a particular day, suppose on the result day tomorrow, uh, people on announcement of the results, quite believing that the results are very, very good, might go into the stock and actually purchase that stock for a longer term. Yes, it is quite possible that the future also might be good, but sometimes what happens is on the result day, because the prices are already discounted, the movement goes into the reverse. Those who knew that the prices are going to go up might sell and the prices might go down. So what happens is averages discount everything even prior to an event taking place. There is an into the brackets, except acts of God. Now, except acts of God is something, you know, uh, is a thing where it's a disclaimer. But generally, what happens is if a technical analyst is actually good, he might be able to predict the markets well in advance, whether there is an act of God or whatever, to predict how the markets would react. And in general, I had told you, what happened in December. I had predicted that the markets would go down. I had not predicted that the markets would go down because of COVID-19, uh, but that was an act of God. So it is. I'm not saying I'm a brilliant technical analyst, but in terms of technical analysis, there are indications on the stocks or technical analysis which give you a perspective of how things could work out in the future. Now, coming to what Dow said, there are three major trends. And the major trend or the primary trend, as it is called, or the long term trend, lasts from a year to maybe 3 years as well. And when the market is going up, it says we are in a bull market. And when the markets trend down, we say that it might be in a bear market. And within those overall swings, there are secondary swings as well. So they are called intermediate trends or medium term trends. They might last from 3 weeks to 3 months, depending on where the trend is moving. And there are minor trends on a day to day basis, uh, which are evident from a week to 3 weeks. Now, like I said, volumes, those who are in the know of things, volumes go with the trend. So if the prices are going up, you can assume that there's volume, and there are a lot of buyers because the demand for that particular stock is going up. So when you look at the prices, it will indicate that the prices are increasing because of more demand, uh, and that is how it is. Uh, the other thing which you should look at, and that is pertinent in the present scenario, is the demand of the stock is going up, or rather, in terms of prices, the prices are going up for one more reason. The liquidity in the markets, and that is, by liquidity, I mean the money chasing stocks, is very, very high, because all the people, all the central banks in the world, across the world, are pumping in money. And you know what Trump did yesterday. So he came out with another portion of pushing up, not literally the markets, but to help out the economy. He's pumped in another push to the US economy as well. Europe has done it, China has done it, Japan has done it, to a certain extent, India has done it as well. Uh, so volumes go up with prices, and volumes might go up when prices come down as well. So the thing is, the prices will indicate, the movement of the prices will indicate how the movement is taking place. If the prices go up, it means that there are more buyers. When the prices are going down, that means there are more sellers. The trend should be assumed to continue until such time as the reversal has taken place and the signal is on. For example, right now the signal is still up in general overall, and I'll come to this later. Um, or rather, I've already put it there. The signal is when a higher top or a higher bottom is made, the trend is generally said to be up. And when there is a higher bottom or a lower top and a lower bottom, it is the prediction for the future is that the prices might go down. So this is very important. This is the most important you keep in mind. If you look at prices, higher top, higher bottom would indicate that the markets might go up in this short to medium term. Lower top and a lower bottom might indicate that the prices might go down. Uh, the next is what is called after Dow. Uh, there's a person called Elliott who actually made a study of the stock markets and said that the markets, the primary trend of the market, which is there, always goes up in 5 waves. So I've indicated the 5 waves there, right since 2002 to 2008. There were 5 waves: wave one, two, three, four, five, and the general wave count which is there is, and this is at the bottom of that the figure. Wave one is the shortest. Wave three is the biggest of the wave, the primary waves which goes up. Wave 2 is a wave which is a retracement or a correction, which is called the primary wave. And wave 4 also is a smaller wave, which is also called a primary wave. So, each of the waves is a primary wave, but then the overall wave from wave 1, which is started in 2002 to 2008, the whole figure would be called a primary wave. So the intermediate waves or the corrective waves would be wave 2 and wave 4. So what happens in the wave count? The primary wave, once it gets over in 5 waves, generally the markets tend to go down in 3 waves. So after 2007, at the end of 2007 or the beginning of 2008, the market started going down. And the market started going down, and the result was it came down in 3 waves. So wave A, B, C. So what it means is wave A comes down, wave B goes up, and is followed by a wave C, which goes down again. Uh, where are we in all this? In terms of the current scenario, I would still assume, and unless the whole market, overall goes above 11,500, I would still assume we are in the primary down wave, where wave A has already been completed at the 7511 level, which started at 12,430. Now we are in wave B, which might end somewhere at the last time I've had said approximately 11,000 levels. It's moved to somewhere around the 11,377 levels, which is the 78.6% retracement of the whole fall from 12,430 to 7511. What do I mean by retracement? you calculate 12,430 minus 7511, and whatever is the differential, you multiply it by 78.6%. You get a figure. That figure you add to the bottom of 7511, it'll give you a figure of 11,377. So, when the stocks retrace, whether it is the indices or stocks retrace any particular level, whether on the upside or the downside, they do it in terms of a Fibonacci number, which is, the last time I might have mentioned that, but at the cost of repetition, the Fibonacci numbers are 38.2%, 50%, 61.8%, and 78.6%. So they can move up to these levels only if you think that it is only a correction and not a new wave or a new primary wave. So suppose 7511 would have been the bottom, and we were in a wave which could actually take the markets up and into a primary wave again, the market might go above 12,000 levels. At least for now, my prediction is that it is not. We are still in that ABC count, and we are still looking at downside risks for the market. These are the different type of charts. On the right hand side, there is what is called the bar chart, and that is what we used to do on the graph paper. What it indicates is, if you look at it very clearly, there on every bar on the left hand side there is a tick, a small mark on the left hand side. Then there is a small vertical bar, and then on the right hand side, wherever it is, there is a small tick again, a small small bar again. So what happens is, wherever there is a small bar or tick on the left hand side, that indicates the opening prices for that particular day or that particular week or that particular month. And during that particular day, the prices move up and down, and the closing levels is shown on the right hand side by way of the right tick, the right portion. On the candlesticks chart, and it is shown on the candlesticks chart on the lower end also, I've shown where the open is at the bottom, and the real body, it has gone up and down on a daily basis or a weekly basis, or you can have it on a monthly basis as well. And then what happens is, it has closed on a high, which means it has made a higher closing than the opening. That is represented by a green candle in the upper chart which you have. So a green candle means the prices are moving up, and the red candle means prices are moving down. Either it can be a red candle, or it can be white candle and a black candle on a black and white screen. So that's the only differential. And these are all the indications of what might happen. The candlesticks are the most powerful of the technical analysis charts, and these are some of the indications of what might happen. A dark cloud cover indicates bearishness in the future. Evening star would be a bearish signal, and since I'm going to actually give you the presentation, you can go through it later on, or if you have any question you can ask me. So these are the different patterns which come from the candlestick chart, which is not really available in terms of the bar chart. So a candlestick chart, which is what we call the Japanese candlestick chart, is a better way of looking at the charts. Let's come to some of the tools which we use in technical analysis. There are resistance and support levels, gaps, moving averages, patterns which are triangles or head and shoulder patterns. Then I told you what a Fibonacci number is. Then there are oscillators, and there is also called what over a longer term or a shorter term also what is called the alternate cycle projections or a previous cycle expansion. Let's go to each one of them. The figure on the left hand side shows you that the prices have been up in the first instance on the left hand side, and has been finding support consistently on that line of support which is indicated there. And then it is at one point of time in 2005 it has broken down, and again then what support level had indicated earlier, that would become the resistance level. So what happens is, if you join two bottoms and make a trend line, it would become a support line. If you have two bottoms and you join it, when you have two tops, you look at the right hand side of that same figure, you have two tops and you extend that trend line, it becomes a resistance level. And incidentally, what happens is the support levels previously happen to be the resistance level later on. And that's the general trend in the markets. Then you have, the support and resistance is one where you actually draw a trend line. The second is where there is a gap. On the right hand side, this is the chart of Sun Pharmaceuticals, and this is live and a live example. What happened, and this I can actually show you by way of, if you can actually see this gap. It suddenly fell with a large gap between the 480 or 90 levels to the 440, 50 levels. What thereafter happened for a very, very long time, Sun Pharmaceuticals could not pierce that gap at all. It is only recently, just a few days back, that Sun Pharma has been able to break that gap and move onwards. So what happens is, on every gap, it went to the gap, it started falling. It went to the gap, it started falling. Ultimately, when the the demand for that stock increased, and you know what has happened in the pharma industry, demand for the stock increased, only then has the stock price crossed that barrier of that gap and started moving up. So it is the reverse in terms of when a gap is made on the reverse also. This is a gap while going up, but suppose there is a gap while falling also, while going up also. When the gap is made, when, for example, it might be there in the case of Reliance and other stocks, when the markets are moving up and the next day the market opens with a gap, the markets might keep going up for the next few days and might come down. It might find support at that gap first before, and then it will go up before it starts falling again. So at that gap level, it might find support. So that is one more area where support at the prices would be made, in addition to the trend line which we had drawn. Where are we today? And sorry for what is there on the left hand side. You can see a black portion there. My laptop has not been working, and I had to make use of my screen, the keyboard on the screen, and that's come on the screen as well. But this is what is appearing as the latest, absolutely the latest Friday levels. If you see what is happening, there are two lines. One, the upper line, it is actually getting resistance at that line, approximately at the 11,320-25 levels. So the what I've done is I've joined two bottoms. I've joined a bottom from here, 1 second, bottom from here, and joined a bottom here that goes all the way to this level, and that has gone to the resistance level. There's one more thing which I've joined, these two lines where a bottom from here, bottom from here, and sorry, bottom from here, and this has gone as a support. So unless it decisively crosses any of these levels, the prices might move in this direction. So all indications are that the market is undecided on what it is likely to do. So what we are called a trap actually. Um, Only if the market goes above 11,320 can the market start going up again. And there's very strong resistance at 11,377 levels, which I told you is a 78.6% level of the retracement. So approximately around the 11,350 levels, it will find very, very difficult for it to move upwards. And any signal for it to fall below this level, which is actually the 10,000, this level, 10,950 levels approximately. If it starts going down from that level, it will indicate a fall in the prices, and prices might come down to approximately 10,500 also. So this is the live example of the support and the resistance level for you. You have one more support and resistance which are formed by the moving averages. Moving averages can be simple moving averages. So if you have prices of say 10 days, divide by 10, so add up the 10 and divide by 10, it'll give you the averages for the next day. So cumulatively, you just move on and on. You take prices of the last 10 days and divide by 10, it'll give you the moving averages on a day, what is called the daily simple moving average, or exponential moving average is also something which you can do on a ongoing basis. So the moving averages also either support prices or become resistance level. Now, if you see this one at this level, if you have taken the pointer here, it acted as a resistance level, and here right now it has acted as a support level. This support level is indicated here. So moving averages are again indicative of a support or a resistance level. So when we call a 200-day average is normally the most important support level or the most important level for a resistance, which was at 10,880. What happened really was it was a resistance level at that level. Once it crossed that level, the market actually zoomed nearly to the 11,300 level. People thought that it might cross that level, and some people are now imagining that it can go to the 12,000 level also. I don't feel so. I might be wrong, but I don't feel that it will go to the 12,000 level again. The scenario is that it has gone above the 200-day average. While falling, it is quite possible that the prices or the indices, Nifty, might take support at that level. But what happens is normally the support is taken only when the prices or the moving averages tend to move up. If you look at the right hand side, I'm again taking the pointer there. This moving average is going up. Only then it can take support. Right now, the moving averages are still going down. So my way of looking at it is that the prices even if they fall, might not take support at that level and might straight away go down to the 10,500 levels. These are called reversal patterns, and these are called patterns actually. On the left hand side, you have the head and shoulder pattern, and the head and shoulder pattern, in fact, like I told you, and I've purposely taken these graphs because they can be applied anywhere you want. The left hand side is a graph of the Australian dollar versus the Indian rupee. What happened was it made a high of 51.62. This is called the left shoulder, the pointer. This is called the head, and this is called the right shoulder. And the line which is dividing that, it is going down. You join the two bottoms. It is called the head and shoulder pattern, and here it has broken the head and shoulder pattern and has moved down. And you can actually measure the extent to which the movement down can take place. I'm not taking it right now, but there is a mathematical reasoning and a tool which says X amount by X amount it can go down below from where it has fallen. So it indicates that the prices might go to that level. Here is a case of crude oil on the right hand side. Now look at it again. It can be applied anywhere you want. This is the currency market. Right hand side is the crude oil market. It made an inverted head and shoulder pattern. This is the left shoulder. This is the head. These are the right shoulders. It can be one or more shoulders. It need not be one shoulder only. Men or we human have only one shoulder, but in the patterns it could be more than one shoulder. What happened there? In those terms, what happened was it failed to actually make a breakout. And it is very important during a breakout, whether it is in terms of a breakout while going down or a breakout which is going up, the most important factor which is there is volumes. There are two factors you should look out for. One, the volumes on the breakout or a fall should be very high, number one, and the breakout or the fall should be with a gap. So near the trend line, near this trend line, it would have fallen with a gap. This is a line chart, so you wouldn't see that gap. But then if you see it on a bar chart, you would actually see that the prices have fallen with a gap, or the prices have fallen with the upside tick. So it all depends on how prices move, and the volumes, which are very, very important. It can be a failed scenario if the volumes are not there, or if it is not with a big gap. Okay, so you need to be very careful where analyzing whether or not it is a head and shoulder pattern. And like I said earlier, it needs to confirm that also. So prices staying below that, for example, prices have fallen here. If they fall here, 1 or 2 days, you just wait and see that the prices don't go up again. So let it confirm that indication that the head and shoulder pattern is completed, and then the prices will go down further. So these are the other reversal patterns: a cup and a handle pattern, a symmetrical triangular pattern, and see the breakout. I've given out, all these are patterns and breakouts from one level or the other. So you can actually measure the breakout and indicate to what level it can be. Just as an example, I'll give you just as an example. If this is a symmetrical triangle, if the base of the triangle is this, you look at the pointer. Okay, this is the base of the triangle. If you measure the base of the triangle on the breakout, the breakout would be approximately equal to the base of the triangle. And look at this, it is nearly the same. Visually also you can see the breakout, visually also the breakout is nearly the same as that. So whether in case of a head and shoulder pattern or any of those other things, you would see this happening actually, and the measurement is very clear. On the on the bottom side of it, there are what is called the double top. Uh, I believe somehow or the other, Reliance might have made a double top or a triple top. For example, it is not moving past the 2195 level. Uh, so this is what happens is it is a reversal pattern. If there is a double top in a price or a indices, the prices tend to reverse and then move on in the opposite direction. If there is a double bottom, the prices trend to move up, which is the reverse of that double bottom. This again is a reversal pattern, which is a ascending triangle, a descending triangle, a rising wedge, or a falling wedge. So all these are triangles, but they are given different connotations because the shape is different. But in terms of you know the measure, it will be the same. Now, if you measure this, sorry, if you measure this, the measurement will be this one. The last base which is formed, you measure this base, and then a fall from here would be equivalent to that measurement. So that is how it is counted. So then you have what is called the flag, you have what is called the pennant, you have a triple top. So the tops are nearly equal, 1, 2, and 3 tops. You have triple bottoms. So these are reversal patterns. So if prices, form these patterns, for sure that it is quite possible that the reversal is taking place. So, the prices might move in the opposite direction for a longer term. Okay, and I'm saying this for a longer term. So these are patterns which, or for example, the triangle and other things might be a short to medium term, but in terms of a triple top or a triple bottom or a double top or a double bottom, it might be a complete reversal of the trend. So it might be going in the opposite direction altogether in a complete change of trend called the primary trend, as I told you. This is what is called the Fibonacci numbers and the patterns which I told you. And if you look at it in a way, and I told you also, if you measure this difference between 12,430 and 7511, you get this figure of 11,377. I'm not too sure whether you're able to see it clearly or not. So that is the 78.6% retracement of the level of the fall. And we are stuck at around that level right now. So previously also I showed you that there is resistance at around the 11,325 to 11,350 levels, and again this resistance at 11,377. So this is a problematic area which can be something which is very important to keep in mind. Prices might start moving down from here. If it doesn't, of course it can move up higher, but we have what is called the alternate cycle projections, based on which we can actually assess where it can go. So the prices, if it has to go higher, above the 11,377 levels, we can assess that it could go to somewhere around 11,530 to 11,600 levels. So that's the take on the markets right now. The next thing which is there is oscillators, and these are very important. There are hundreds of oscillators. I'm not taking all the oscillators right now because there are hundreds of them. Only the very important one is what I'm taking. The ADX, or the average directional index, is designed to quantify trend strength by measuring the amount of the price movement in a single direction. Okay, so that's one. Relative strength index is a momentum indicator that measures the magnitude of the recent price changes. So the relative strength of a particular stock or the indices is provided by the RSI. Now, when it crosses the 70 level, the RSI, we say that it is in an overbought zone. If it falls below the 30 level, it is called, we are in the oversold zone. But what we are seeing right now in the markets is Nasdaq has crossed the 70 and it is right now somewhere in the 80 levels, but it is still going up. So you need to be cautious at these levels. So that is the only point which needs to be considered. Going below the 30 levels also, in fact, what happened at the 7511 level, it went to the 20 levels also. And that is the level when one thought, oh, the prices definitely should move up now. And the bottom might have taken place. So these are indicators which indicate whether a bottom has been made or not. So these are indicators. MACD, or the moving average convergence or divergence, um, indicates a confirmation of an upward trend or a downward trend. So there are two lines there. It is based on two moving averages, either the 14-day moving average, which is one indicator, and the second is the 8-day moving average. One moving average, that is the 8-day moving average, crossing the 14-day moving average from below, and where both are moving up, will indicate a bullish sign, whereas both falling and the 8-day moving average, going below the 14-day moving average, will indicate a bearish sign. And a Bollinger Band is something where it's a standard deviation, two standard deviation of the prices of the stock. So you have, in the fundamental analysis, when I told you standard deviation, you have the upper end of the chart, which will give a level of a resistance to the prices, the lower end of the prices, which is the, so what is it is called, the plus or minus 2. So the minus end, which is the bottom, will indicate a support to the prices for in case of a Bollinger Band. Then there is what is called the stochastics. You have the stochastics created, which is, I'm sorry, there can be two moving averages. One is called the percentage K and one is called the percentage D. So the percentage D indicator of the stochastics is a slow indicator, which is a better indicator than the indicator of percentage K. So again, you can take the 14 and the 8-day indications as the indicators for the stochastics. Again, the stochastics can be somewhere in the region. When it is overbought, it can nearly touch the 100 region. So it can be 98 or 99, and it'll be called the overbought. Nearer zero, it'll be called oversold, extremely oversold. So again, it is the 70 and the 30 which is counted, but normally stochastics go as high as above 95 as well. Rate of change or the momentum indicator is something where it is the change indicator where it compares the current price with the previous price from a selected period. So when a price is divided by the previous price and expressed as a percentage, this gives you the rate of change. This indicator is also called the momentum indicator because it gives you the momentum whether the prices are going up or down, and also can indicate a negative divergence um, in certain circumstances. So I will see whether you know look at this level now. I've come back to the slide which had the oscillator, sorry, Fibonacci retracement. Look at this indicator now, and you will see the prices are going up, whereas the rate of change indicator, which is the oscillator, that is coming down, which means there is a negative correlation between the prices because the rate of momentum in the prices has now moved down, which is a definite indicator that the prices are likely to move downwards rather than upwards. So around this level, I am 100%, I would say 80 to 90 to 100% cautious that the prices might not move up. And this is the RSI. RSI, you don't look at the RSI here because the number is here. RSI is not actually 25, it is much higher. It is somewhere around the 70 levels. So that again represents a case where you have the RSI nearly being overbought. And I also told you the volume indicator in case of any of those graphs or the patterns which I said, any breakout or a breakdown should be followed with a volume indicator. There has to be large volumes. So only then can a confirmation take place. So these are the oscillators. Then there is what is called the volatility index. You need to also look at the volatility index for all practical purposes. It indicates how volatile the movements are. In fact, something like the 14 or 13 or the 14 levels indicates it has a inverse relation to the prices. At 13 or 14, the market, in fact, was so volatile in the Nasdaq and all other indices, even the Indian indices at the 12,000 level, the volatility index was around 13 or 14, which indicated that the prices are likely to fall. Currently, it is somewhere in the region of 22 or 23. So it is not a absolute 100% indicator that prices might fall, but a relative indicator. It You have to look at all the oscillators before you come to a decision. So, like I'm not sure whether I told you, if you have to actually pick up a index or a particular stock, it is not easy to assess a level or assess the movement of the prices in future very easily. People tend to look at the charts and say, oh, this is how the movement will be. It takes me nearly 3 hours to assess one particular stock or one particular index. You have to see the trend lines, you have to see the patterns, you have to see the oscillators, you have to see the support and the resistance levels, the short term, medium term, long term. So it takes a lot of time. So while assessing the markets, you need to be very, very careful, and to be a good technical analyst, you need a lot of time. Involve yourself in technical analysis in a particular stock, give time for that, assess it properly, and then arrive at a decision. So that is a very, very important aspect which I would like to tell you. You can't see the chart and say, oh, this is what is going to happen. That is foolishness, absolute foolishness. I think while doing the first program on the wealth management and financial planning, I had taken up this sector-wise analysis and the rankings as well. I think I took this the first session somewhere in the month of June, and then I took it in July, and look at the prices. What has happened between July and August? The prices have moved up. Index has moved up by 5%. Auto has moved up by 7. Banks, which I was cautioning everyone not to go enter into, have gone into a negative 4%. Energy, which was okay and skewed, I told you, and that was because of Reliance, has gone up by 6%. FMCG has not moved because of the lockdown, because people are not going out and buying things. IT has moved up substantially because that is the only sector where you have been able to actually work from home, and the results have been good. Whether it is the Nasdaq or whether it is the Indian IT sector, work from home has been one of the factors which really has seen that the sector has really moved prices. And if you see uh, what has happened to the others, 16% in case of IT, metals have moved up 13%. And why has it moved up 13%? If you look at the next chart, uh, the metals were the least, was the worst performing sector which was there earlier. That was, sorry, that this was in the month of June, yes. And right now it is playing catch up. So others have moved up, metals had not moved up. What has happened is people have started getting off out of stocks which they think are overbought and started getting into metals. Um, Another reason for that is the Chinese production has started increasing, and China is in a better position right now in terms of GDP growth. The demand for metals is quite strong there, and one of the reasons why the metal prices have started going up, like for example, steel as well as aluminium and other things have started going up. That's one of the reasons why metal prices have followed. But if you see the others, pharma has moved up by 14%. This is the next best sector. And sorry, and I've always recommended pharma from day one. In fact, even in June, I have not changed the sequence of the rankings. Right since June, pharma was number one, pharma remains number one, and it has gone up 14%. Capital goods and banks, which I always said are not likely to go up, have remained negative. So those remain negative for me even in the longer term or short to medium term as well. Let's look at what I had actually indicated. Autos. Autos have moved out by 7%. And what did I say? It has already gone through a 27-month bear plunge, has shown slow green shoot reversal, but might trend down after retracement of 38.2%. Right now, the retracement which has taken place is 40.51%. So the likelihood is that things might, reverse, and then there might be a fall. In terms of FMCG, IT, as well as pharma, I had said that this is a defensive sector and it was to be held. The only sector which I said was a dark horse, in July I said it is a dark horse, was the metal sector. And here it is. When I said it is a dark horse, it was very a clear indication that metal sector was the only one which has not gone up and it will play catch up. And it has moved up quite a bit. It has moved up in a month, it has moved up 13%. I continue to remain in the same stance. The ranking remain the same. I'm not going to change the ranking because I still feel even if the market falls, the market will fall with pharma, IT, as well as the FMCG index might not fall to a great extent. The others might fall badly, if at all the market moves down again, and it is likely to. So that is the way I look at it. And this is only a takeaway from the previous slide. And in fact, this was in the earlier slides also. You can have a look. I can now move to the mutual fund products because I had not taken it during the last time. I had actually taken it during the first session when I had taken financial planning. Mutual fund products can be equity products, or debt products, or money market instruments, or index products, and then it can be hybrid funds, which is balanced of both the debt instruments as well as listed equity. There are income funds or the fund of funds, where a larger fund or a corpus, for example, I had indicated earlier, a corpus where there are superannuation funds of General Motors or General Electric there in the US. They want to invest in the Indian markets. They might invest in a fund in India. That is a larger fund in the US, which invests in a smaller fund in India. For example, they invest in a HDFC fund. So it is called a fund of fund. Fund of funds is the General Electric fund would be a fund which is investing in the fund of funds. Specialty sectors would indicate there is a financial sector, fund which comes up. There are many funds. I will show it to you by way of an example. The selection criteria, and this is very important. Management of the mutual fund is very important from the way a fund of repute and fund which is transparent. Fund which is transparent, you can actually go into a fund like HDFC mutual fund or a SBI mutual fund versus, for example, a DHFL fund, which are the worst, or for that matter, even the funds which have gone down right now. Those don't look good because they are not transparent and they are not. The age of the fund is also very important. The SBI mutual fund is one of the longest serving mutual funds, or the UTI fund is one of the longest. So they have a very, very old lineage to it. The managers of the fund is the third very important aspect which you should keep in mind. A reputed manager of the fund is very important. And by manager, I say a person managing the fund. Then you have the choice of the fund, whether you want to invest in equity, debt, index-based fund, or a balanced or a hybrid fund, or a sector fund, depending on the circumstances that exist in an economic cycle. Are the positions leveraged, and what is the hedging strategy? So it all depends on the choice of the fund, depending on all these factors. Another factor which you should always look at is the management charges of the fund. If the management charges are 3%, it is going to impact the NAV of the fund, and your returns depend on the NAV of the fund. The calculation is dependent on the charges. So if the charges are high, then you need to be very cautious. Just look at the prices of the charges of the NAV charge, in terms of each of the funds. Then you have the online access on a daily basis, whether the changes take place for each of the funds or not. So whether you go to say a HDFC fund, you go to their website, do you have your fund, the NAV on a daily basis or not? It keeps changing on a daily basis or not is very important. So do they have online access? Most of the funds do, but then it is very important. What is important is the NAV ratio, the expense ratio, and the portfolio held. So you can also look at what the portfolio of that scheme is versus the ratings of the paper. For example, in case of a a fund which is a debt fund, they will also have ratings for that particular paper. So if it is AAA and they are safe ratings, you can very well go into that rating and you invest in that scheme. You won't have problem. So the NAV you should have is over a 1 year, a 1 month period or a 6 month period. You can compare it with a 1 year period or a 3 year or a 5 year period. Um, let's now look at, I had shared this. I don't know whether you all have been able to actually go to the go through this presentation which I had given earlier. If you had gone through the presentation, I will show you the example of a debt fund, a long-term securities fund. Now look at this. If you, can you see everyone see this?
Yes, Sandeep, you can see.
You can see the slide of the mutual fund. Okay. Now see what is there. I clicked that link and it's come here. This is the IDFC Government Securities Fund investment plan, a regular plan. And it says over the last 1 year, if you had invested 1 lakh, your investment would have gone up to 1.13 lakhs. Now, let's look at what all things you should be looking at. This is just a graphic example, but what should be you be looking at? Now you have everything there. Now you have a 1 day trailing return. You have the 3 month, 6 month, 1 year, 3 year, 5 year, 7 year, and 10 year also. So all the the returns, trailing returns are there. You have a peer comparison of the funds also over a period of time. You have the IDFC Government Securities Fund giving a 1 year return of 12.6%, a 3 year return of 9.55%, a 5 year return of 10.23%. And you have a comparison of, you go to valueresearchonline.com, you go to funds, valueresearchonline.com, you go to funds and you can find these out. You go to the performance and you will get all these indicators. So you can compare IDFC with the SBI, You have Nippon India Gilt Fund, Nippon India Gilt Securities, and DSP. So which one is the best? IDFC seems to be good, remains to be okay from the point of view for the in fact during the last month I had seen that the return for the 1 year period was nearly 15%. So it is moving in the opposite direction. So the yields have been going, yields have been going down. So though you are making a return, it is not the best investment you can say, because the returns might be a little lower. The best and the worst scenario is looked at here for that particular fund. So you have almost everything which is you require. The risk measure you have for the fund, you have versus the sovereign bonds versus the gilts, that is the government securities, the ranking, and in this this type of fund there are 25 funds. So you have the credit quality which is very high, and how do you know that the credit quality is high? Because there are the top holdings are all government securities. You see that the holding for that particular fund has GOI 2027 bonds, GOI 2029 bonds, uh, 2028 bonds, and see, these are government bonds which are very, very safe. So what it indicates is this is a fund which is safe. At least you will not lose money on this fund. And who is the manager of the fund? I just said Suyash Chowdhury is the manager, and he is reputable from the point of view. He's a BA honors economics, and also IIM Calcutta alumni. So this is one of the things which is very important. You should, go to a particular section of, for example, value research online, or I can also show you the other one. So you have, what did I do earlier? You have funds or you have stocks, but you do funds. You then say what fund, what type of funds do you want? A wealth fund, select the number of years. Say you want to a 1 year to 3 years, and you say you wanted an Excel format. It'll give you all the short duration funds for 1 to 3 years. It'll give you everything. So it'll give you, see, the return for a short duration fund is about 11.33%. For a SIP it is 12.79. That is how it is. So this might involve, actually this might also involve equities. So it depends on, since I actually chose growth, this is given you growth because equity also is covered in this, and it is 12% plus right now, but over a period of time it might be lower. The reason is the markets have come down over a period of time. Okay, so this is how you actually go into a mutual fund, position, and then you actually see which is the best. You know how to actually sort out the data, right? You sort out the data by, you know, in the Excel, everyone knows how to do it. You choose what is the best return. Suppose you want a 3-year return or a 5-year return as the best one. You select that and then sort out which of the bets is in terms of the fund there is. Okay. It's also given here. So when we took 1 year, if you change it for 3 years, it will change it automatically for the 3 years. See what has happened. For a 1 year, it is 8.9, and for 3 years it is 3 years it is 8.9. For 1 year it is 11% for Axis. So you can actually juggle and see what is good for you. You know, you have money to invest for 1 to 3 years or 1 to 5 years. You then choose which is the best fund, which is the fund which is offering the best return. For example, ICICI Pru short term, I think 9.5 has been the best so far. Okay, but then look at the rating of that fund. Is it good? 9.5. It is, rating is 4. It might not be that good. You know, it might be risky. So if you go and see, you click there and see what are they holding. You compare it with the others. Okay, ICICI Pru is compared with the others, right? 9.5, all the others are here, but look at they are doing 11.74. Yes, in the 1 year period they're consistently doing well. And see the expense ratio for each of the fund is also provided. The most important thing you should look at is what is the holding. Okay, look at this holding. They are holding all this, which seems to be a good, secure portfolio. All A-rated stocks. A-rate. See, the credit rating is here. This is sovereign bonds. Then AAA rated, paper, which is a non-convertible debenture. It's a very, 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 very good thing to sign up for. So this is how you choose a mutual fund when you want to invest. I think I've taken this already during the last session. I'm not taking this, but you can go through it because I'm going to share this. And even this one, I think I've taken it during the previous sessions earlier. And of course, the do's and don'ts in investing is something which I've taken repeatedly. Avoid a herd mentality for investing. Thank you. And there is something important which I wanted to actually share with you, and that is technical analysis versus fundamental analysis. Now, technical analysis is applicable to all markets, whereas fundamental analysis, it is very difficult to actually uh, analyze because there are heaps and heaps of paper, and the whole idea is it is subjective because it needs to have, if you want to work out anything at all, uh, you need to have a discounting factor, and what discounting factor do you assume is something which is very, very difficult. So it is not very easy. So is it possible to actually do a analysis of, say, oil or something of that sort? It's difficult. Whereas technical analysis, it is, if you have charts uh, of each of those, you can spend 2 or 3 hours on each of the charts and assess where you are going and how things are going for oil or, for example, gold or whatever it is. Um, Technical analysis, most people think that it is for the short term. No, it is not. It is for the long term also. You can analyze it for 3 years or onwards also. Like I said, alternate cycle projections. It can give you indications of where the prices will go. You know, the levels it can go after a particular, a fall in the market. You can actually assume and make out where the markets will head towards in the next run, in the primary run. Analysis can be applied to macroeconomic factors through study of all the commodity prices or interest rate factors. So what happens is the stock, when you are actually analyzing the stock markets, what I do is normally take all the charts into consideration, whether it is the commodity markets, whether it is oil, whether it is gold, whether it is currency. I analyze everything, and based on each of the analysis which I make for each of these things, I then arrive at the analysis for stocks. What is the factor which is likely to impact the prices of a particular stock or the indices? So, it gives you the macro picture, which is very, very important from the point of view of analyzing prices or the indices. The data can be used for algo trading or arbitrage as well. So it's much easier to forecast than fundamental analysis. I just wanted to show you this again because I had tweeted this a few days back. Nifty has gone in an overdrive after crossing the 200-day DSMA, while on the upside, 11,377 would be a level to watch. The end of this week or that week, actually, 11,125 closing would be most crucial. What really happened that day was, that week was, it really crossed the 11,125 and made a wrong suggestion that it is going to go up. It went to 11,344 and then started falling. So it did not cross 11,377. So there could be, false alarms which can be there, and you have to be very careful. And again, I keep saying there should be a stop loss for whether it is short-term trading or whether it is long-term trading. So that is very important. And there is one more thing which I had said. When the price of Reliance actually was nearing 2,200, this is what I had tweeted the day when there was an announcement for takeover of futures retail. So I still believe Reliance at 2,200 levels could be, it is difficult to cross it, but if it crosses it, I'll have to revisit the whole, I will actually have to say that I am wrong on my reading of the stock. I will have to redo the analysis myself, and that's where it is. So that's where I complete the exercise. Thank you, and now go ahead with the prarthana, please.
नन्दन्तु साधका सर्वे विनश्यन्तु विदूषकाः अवस्था शाम्भवी मेस्तु प्रसन्नोस्तु गुरुः सदा सर्वे भवन्तु सुखिनः सर्वे सन्तु निरामयाः सर्वे भद्राणि पश्यन्तु मा कश्चित् दुःखमाप्नुयात् ॐ शान्ति शान्ति शान्तिः.
Thank you.
Thank you, ma'am. Thank you so much.
And take care everyone.